Hi, everyone. Welcome to Mullers on the Move. We are the Muller family of 5 traveling around the country doing travel healthcare assignments. I'm Paige, nurse practitioner turned homeschooling mom. Blake is the one actually working as a CRNA. Today we have a special guest, my older cousin. Her name is Missy Terito, but you will hear me call her Missy. There is just no way to change that after this long. She is the host of 2 podcasts, Louisiana Ladies, which you can check out my episode from way back when my life looked a whole lot different, and the Sitting on Pension Show.
I'm Blake, the locum CRNA here, the nurse anesthetist. And Missy, you can go do a short formal introduction if you'd like.
Oh yeah, I'm good at that. There's
short. I said short.
So thanks for having me on, guys. I am Paige's older cousin, and I'm actually the oldest cousin on the side of the family that we are all related. So that's par for the course because I'm bossy, just like Paige. Like I said, my name is Missy Terito. My friends and family call me Missy. Do have 2 podcasts, but I also have a real job, and that I'm a partner at a CPA firm here in Baton Rouge, Louisiana, overseeing our retirement plan consulting area. And Blake,
should have started with that. That's actually your title, but you know.
It is. It's okay. That's make me sound less.
2 podcasts with no title. Yeah. She's kind of a big deal, everybody. We're honored to have her.
Yeah, the podcast just reiterate the fact that I'm a fun CPA, also administrator. So anyway, glad to be here. Blake, so you go ahead.
So the main topic I wanted to cover on this podcast, I'm sure we'll cover a lot, maybe even family dynamics. Who knows?
We're not getting into that.
Is obviously we're always trying to, as professionals in general, trying to lower our tax burden, and also just how can we save as much for retirement, so you can either retire early or retire comfortably, however we both can do it. Well, I wanted the focus of this podcast mostly is on a retirement plan that's called the cash balance plan. I consider myself slightly educated in finance, and although I just give anesthesia for a living, but I had never really heard of an actual cash balance plan until earlier this year. I have done SEP IRAs in the past. I do a solo 401k now, and now this cash balance plan was introduced to me. So it was got my wheels turning, certainly, and I did a lot of research on it. I did a little, pro bono with you on the side, how we get explaining this further to me. And I guess let's just delve into the cash balance plan and pros and cons and et cetera, et cetera.
We traded wine for wisdom on what this was a couple weeks ago.
Lots of wine. So a cash balance plan, like I'll tell you, there's a lot of people that have never heard of what a cash balance plan is. And I will say that Paige is one of them, but I will say that, it's a specialty because you have to have an actuary that runs these calculations. So just in general, there's a specific demographic that we're looking for a company that's going to be a good fit for a cash balance plan. I get this question a lot, right? So I work with tax CPAs. I do not handle taxes. That would be a terrible job for me. I get to save people taxes and help them save for retirement. So I'm like, well, why would anybody want to do tax work? But anyway, it's a necessity. But I get this question a lot. I go talk to a prospect and they're like, well, how come my tax CPA didn't really bring this up to me? Most of the time it's because they're either just unaware of it, or it's possible that you're not really a good fit, whoever the client is, and it just never came up, right? Because we have brought this up to people before, and you gotta be willing to put in the money, and you gotta be willing to come up with the cash to do it. But that just kind of putting that out there, because I feel like anytime I start talking about this, that's what people are thinking. Well, I've never heard about it. Why have I never heard about it? It's a specialty type of a retirement plan that can be extremely beneficial to business owners when everything works out like it should. And so, Blake, I'm going to use you as an example, if you don't mind. Are you okay?
Yes, I feel like most people are kind of set up the way I am as a 1099 CRNA. Yes. Most people do an S Corp, pay yourself a W-2 salary, and then, yeah. So
Yeah.
use me as an example for
So we
sure.
won't use actual data. I'm going to throw out some, hypothetical numbers, but you are, and Blake, I know this is really going to make you feel good about yourself, but you are a perfect example
Woo!
of
You've told that
why
so many times.
this can be so good. Well, one, it's because I can control a lot. I can tell. Okay. So we'll talk about it from your standpoint, but I don't want to neglect the fact that, sometimes there's 1099s that have a S corporation and they might have employees in there. And I'm not going to go into nitty gritty details, but for our purposes, you have what we call a solo K. Just to let everybody know, there is no such thing as a solo K. A solo K is strictly a marketing term. A solo K is just a 401k plan with an owner and their spouse, all right? Or an owner only and an owner and their spouse, okay? And what that solo K allows you to do is you don't have to do all of the required filings that, let's say you had 5 employees, you would automatically have to start filing stuff with the IRS. We handle that for our clients, but because you're a solo K, you get a waiver for a couple of years. That's the only difference. Okay. I hate to bust everybody's bubble. Financial advisor that's trying to sell solo Ks, it's just a 401k plan. It's just the number of people. Great marketing ploy, great marketing term. But anyway, but we call them like that too because it's easy for us to classify them internally. So number one, let's start with why would you, as a 1099 contractor who has an S corporation, why would you do a solo K as opposed to a SEP? Do you know the answer to that?
You could put more into it from the employer and employee side.
Yeah. So your SEP for all of it, I hope everybody that's listening can do math in their head. Let's say you pay yourself, a business owner pays himself a salary of $100,000 because this is easy math. Okay. Well, if you do a SEP, and let's say, and by pay yourself, that's just your W-2. It does not mean that you're making $100,000, right? When you set up that S Corp, I'm not going to go into those details, but you have distributions, you have K1 income. That's not included income for the 401k plan. So you're cutting yourself a W-2 of $100,000. That's reasonable. 25% of that is what you're limited to in the SEP. 25% of $100,000 is a $25,000 contribution. The reason why we set up a lot of the 4 solo Ks is because in addition to that $25,000 contribution that you could do in a SEP, you can also withhold up to $23,000, might be $23,500. They change the rules every year. So now you got a much bigger, and that's going to accumulate over time. This is what I tell people. People have a tendency to want to look at this as like a singular year. And I'm like, but if you put in $23,000 more a year
That compounds quickly.
with interest, you've got a lot more savings, so people want to look at it like
In 4 years, you had 100,000.
yeah,
Plus
exactly.
plus
They want
compounding.
to look at it very statically, and that's not how it works, right? The point is for it to grow. You're also going to get a larger tax deduction. I mean, if you're putting in 25,000 plus another 23,000, you've got a good $15,000 tax deduction. I tell people all the time, you can either pay the IRS or you can save for retirement. I mean, that's kind of your options.
Yeah.
Like money's going to go somewhere. So on top of that, 25% contribution to the solo K, which we call it a profit sharing contribution, you can add on the cash balance plan, right? And this is when people really start to see a lot of tax savings, okay? So in general, your cash balance plan, you're going to be able to put up from $100,000 to $200,000 more in a cash balance plan, okay? Very, very general sense, okay? And when I say put it in, Paige is kind of looking at me. I mean,
Like you can put that much in every year?
yes.
Okay.
Yeah. Okay. So what's the pro of that, right? Pro, huge tax deduction. You put in $100,000, you're in a 30 to 40% tax bracket, you're saving $30,000 to $40,000 in taxes. 2, accelerate your retirement savings, right? You're putting it in there. You're going to probably forget about it. I mean, I'm sure you're going to manage it, but the money's going into it's very strategically going into a retirement account, right? So with somebody that has fairly consistent cash flow, that has a big tax liability, those are really the 2 things that we're looking for. And if you don't have employees, if you have employees, you can do it as well. But if you don't have employees, it's just real easy because I can say Blake, I need you to cut yourself a W-2 of X amount, and this is the exact amount that you can put in the cash balance plan. Now, the range that you can put in depends on two variables. It depends on your age. The older you are, the closer you are to 65, the more that you can put into a cash balance plan. Okay, this is just an IRS table limit. Anyone can go Google this, okay, and look at cash balance. Two, it's your pay. All right. So when you look at some of these charts, it's going to basically assume that you're paying yourself over $300,000 in W-2 wages. So you just have to kind of manipulate what the percentage is. So for someone about your age, Blake, we're about 40 to 45% pay that you could put into the cash balance plan. Okay. And again, this is all going to add together to that $50,000 that we might be putting into the 401k plan, right? So now it's $50,000 a year. We're putting in $120,000 a year in totality. Again, that's going to grow. It's tax free when you put it in, and it's a tax deduction. So let me stop there. That was a lot. What you got?
I have, as somebody, like we said, I do not know much about this at all. I am not the financial guru of this family. Is it strictly a retirement fund like a 401k where you get dinged if you take it out before 65? Okay. So
Yes.
it's okay.
Similar. So, I feel like there's people, it kind of reminds me of like the doomsday preppers, or, like some these philosophical, people think differently about retirement, right? Because I get this question a lot, just to be transparent. Well, Melissa, am I going to get taxed when I take it out? Well, yes, because we cannot, unfortunately, I'm not the IRS. We cannot have our cake and eat it too. But the theory behind this is that if you are making a large amount of income with predictable cash flow and extra cash, you are probably going to be in a higher tax bracket while you're working than when you retire, right? So what'll happen is you'll roll the money over into an IRA or an annuity, and you're just taking money out to live off of, but you don't have this. You're probably not going to have a bunch of, why would you want excess income to be taxed on in retirement that you don't need? You've already got your nest egg, So right now, we're all, even though you are younger than me, we're all trying to earn enough to be able to retire. But in retirement, I mean, unless you have a side gig like my dad, you're not really, most people have contributed enough, and you're taking money out, and your tax bracket might be lower, right? So again, the way I look at it is instant gratification for me. I want to go ahead and take the tax deduction in the years that I can. I also don't know what's going to happen 20 years from now when I retire, right? So could I have a higher tax bracket, a lower tax bracket? I don't know. The only thing I do know is what tax bracket I'm in today and what my tax savings are today. So trying to predict the future with those things, some people come back and they're like, oh, I don't want to do it, Melissa. I'm going to have to pay taxes on it eventually. I'm like, but you're paying taxes.
Yeah, but it also is compounding and growing
right
while it's sitting there.
Right. And it's
right. So
yes. And yes, you have to pay taxes on the growth, but again,
yeah, but still it's
in there and have it grow. Pay the IRS today. I mean, whatever floats your boat. I don't like to pay the IRS, but that's just my opinion.
Blake, and the other like name for this is defined benefit plan, like a pension plan. Correct, is how this works.
Yeah. So no, that's a great question. So what makes the cash balance plan unique is that, and this is where I'm going to get a little nerdy, so just work
nerd out on us.
Okay, is that for illustrative purposes, we look at the cash balance plan and the 401k plan as basically one plan to maximize your benefits. A traditional defined benefit plan is completely separate in terms of the compliance rules, it's completely separate, and it's got a different, they're just different, and most people do not set up a traditional defined benefit plan anymore. In fact, the actuary I use, his name is Tony, and he's fabulous. he has told me before, he was like, I would argue any day of the week why somebody needs to do a cash balance plan over a traditional defined benefit plan. And he's an actuary. He can do both, the cash balance plan is easier to understand. Okay. Because like I just told you, Blake, you could probably put in 40% of your income based upon your age. That's easy for you to understand. A traditional defined benefit plan is basically taking your benefit at retirement and backing into what your contributions are. This is the same in terms of you're going to have a limit. So just to I want to point this out. A lot of times we set these up for people probably mid 40s, even though we have some people in their late 30s, mid 30s, we're setting them up for. There is a total limit that the cash balance plan will get to. It's about $2.9 million right now. Okay. And that's where you kind of max out. So the longevity of a cash balance plan, when somebody's about 50, I'll use that as our gauge. When somebody's 50, it's about 10 years that they're going to be able to contribute to the fullest, to maximize, and then they'll hit a max. But that kind of works out with them planning for retirement, right? So that's a limit that it has.
Obviously, once you reach the limit, you can no longer do the cash balance plan. Obviously,
you would
right?
freeze it, you would terminate it, you would roll it over. Yeah, you would do that. But it takes a while to get there. It's gonna be you're gonna get there quicker if you are drawing a salary of $350,000, which I don't want to say I don't recommend that. Some people have to do that. It just depends upon their profession, or depends upon if they have partners in the organization. But if they're drawing $350,000 because they're trying to put in the $250,000 in the cash balance plan, they're just going to get there quicker. There's nothing wrong with that, right? It depends on what people want to fund. But before everybody's like, yes, we're going to go and do this. Okay. You need to commit to it for about 5 years. So if you're a business owner and you start a cash balance plan, the IRS is not going to look favorably upon you saying, I'm going to put in $80K to this cash balance plan this year because I got a lot of money. And then you don't do it every year from there. So typically that first year that you fund, that's what you need to plan for funding every year from a cash perspective. The cash balance plan is also subject to market gains and losses. Okay. So typically we're going to use a 4% to calculate what this number is that goes into the plan. So let's say we're using 4% in our calculation. And by our calculation, I mean, that's when I tell the client, this is what you can put in to the plan. Okay. Contribute to the plan. So let's say we're using 4%, but the market your balance loses 10%, right? Now you're looking at 14% that you're going to have to make up. You're going to have to make that up, right? So when I talk to financial advisors, and I'm not a financial advisor, but this needs to be a more conservative type of an investment in the cash balance plan, because you're kind of just seesawing, right? So that's where it looks a lot like a defined benefit plan, Blake, because you do have certain required funding every year to keep it funded.
Gotcha.
What happens if somebody after year 2 or 3, they're like, I can't do this anymore? Is it just like a red flag with the IRS?
Could be, yes. Typically what we end up doing is we can freeze the plan. So we can freeze the plan. The earlier in the year we know about it, like you really need to freeze the plan. So if we're going into 2025, somebody really needs to tell me in March or April if they want to freeze the plan for 2025, and that's really where having a CPA that's looking at cash flow predictions and projections for your year, even early on in the year, can really help out with that. But that's a good question. So IRS has a permanency rule when it comes to setting up these plans, and that is that the intent is to set them up and keep them funded until they are at their limit. And the problem is, the biggest risk that I've never, ever seen happen, in full disclosure, I just have to say this, is that the IRS comes back, they say, okay, this plan is disqualified because you did not set this up with the intent to fund it. We can tell because you did it for 2 years and you haven't done it since. You're definitely at a bigger risk if you have employees in this particular case. IRS isn't that worried about business owners. they can disqualify the plan, and those tax deductions that you took in those prior years now become taxable.
Mm-hmm.
That's extreme. I mean, that's extreme. So let's talk about how you're set up, Blake, with a W-2. Okay. So what we would do for you is you would decide on a percentage of your W-2 that you are comfortable with funding. Okay. Let's just say it's 40%. Okay. I'm like, Blake, the most you can put in is 45. And I'm throwing these numbers out. I'm looking at this chart, but I'm not that smart to do the division in my head. Let's say it's 45%. And you're like, well, I'm comfortable with, let's do 35%, Missy. I'm more comfortable with that. Let's start low, because you can always increase that over time as well. So I'm oversimplifying this, but let's say you did pay yourself $100,000, just hypothetically, right? So you're like, okay, well, I'm looking at a $35,000. I'm comfortable with 35%. I'm going to do $35,000. Well, the next year, maybe your 1099 is fluctuating, whatever it may be. Well, all we're going to do is we're just going to lower your W-2. Because it's a percentage of your W-2, right?
It's more important to keep the percentage, not the actual. So for people who don't know, or who for 1099, like Blake is a 1099 employee. He does not work for a hospital as a W-2 employee. He works for multiple people, and he has an LLC set up, and then he pays himself. Just for anybody who is financially illiterate like me, that's how his is set up.
And the reason why that is ideal is because you have that S corp, Blake, because you have a W-2, because at the end of the year, if you set this up, I'm going to say, Blake, here's your W-2, here's your percentage of pay, here's the market gain or loss. It gets a little, it's harder to predict if you are a 1099 and you're simply running everything through your individual tax return as a Schedule C, because now all your income is self-employment earnings. And so unless you have total control of what that, I mean, most of the time that's going to be your profit, right? I'm looking at your net profit on your Schedule C. So that's harder, because that number, you could have more expenses one year. You could have more income, right? So we have a couple, actually, I don't know if I think the only Schedule C that we had converted to an S corp, probably for that reason, on a cash balance plan.
Yeah. I think most people in my profession do the salary that they can give themselves a W-2 salary that they can come close to maxing out the solo K. So,
Yeah.
So the max solo K is what, 66,000 a year? Is that what it is now?
Yeah. And normally that's where that sweet spot's normally between 150 to 200 on the W-2.
Right. Right.
Yeah. It's around there. And that's, and that's where, I run into this a lot, and I will say this is an unpopular opinion, but I run into a lot of business owners that their K1's really high, their company's doing well, and they pay themselves $60,000 in W-2 wages. So in a land far, far away, a long time ago, some CPA told S corp owners that 60K is a reasonable.
It's a magic number, huh?
Magic number. I do this all the time when I set these up. I'm like, you got to increase your compensation. Like, this isn't, I hate to be the bearer of bad news. And so you got to also understand that the IRS, now again, I'm not a tax person, but if you look this up, the IRS wants S corp owners to pay themselves a reasonable W-2 because of FICA, which is your Social Security and Medicare. So if they come in and they see that you're basically not paying yourself enough to avoid FICA taxes, that's going to be a red flag on your company as well. So there's a middle ground, right? There's no real right or wrong number. There is a middle ground. There's a benefit to setting up an S corp because some of your income is not taxed at FICA.
And obviously, if you're just doing a solo K and maxing at $66,000 or whatever the exact number is in the 60s, I mean, obviously that's still a whole lot of money.
Yes.
Annually, but if you have money to spare and want to save a lot on taxes, you could increase that by almost 40,000. And for the cash, you could almost put essentially at this salary W-2 and how I'm set up, you put about 100,000 into the cash balance plan.
Yeah, and if somebody is like 55, you're looking at let's see if I can do this really quick without if somebody's 55, you're looking at about 85% of pay. So if they pay themselves $100,000, you're looking at $85,000.
On top of the
On top of your 66. Yes. Yeah, that's a lot. Okay, so
yeah,
let me tell
that's
you real quick.
150.
Let me tell you real quick when this doesn't work.
Curveball.
I had someone call me that y'all know
Oh, Lord.
and said, Blake told me about this cash balance plan.
Trying to refer to you.
You were. No, it was great, except this person was not set up correctly. And this is also very common. I see it all the time. Okay. So let's say we have 3 partners, 3 business owners in one company. All right. And that company is taxed as a partnership. Okay. Not an S Corp. So the company is taxed as a partnership. Don't worry about who owns what. Just know that it's taxed as a partnership. What a lot of people will do so that not all of their income, again, think of a partnership kind of like a sole proprietorship. There's just more than one person. So all of your income is taxable for self-employment earnings, which is FICA, Social Security, Medicare, right? So what they'll do is each partner will create an S corporation, and that S corporation, that LLC, taxed as an S corporation. Also, to the audience out there, an LLC does not tell anybody how you're taxed. That just says that you have an LLC. All right. So it's an LLC taxed as an S corporation. And that S corporation is the partner in the partnership. So what we'll have a lot of times is they'll say, well, I have an S corporation. So can I just set up this cash balance plan for this S corporation? And it would seem like you could, right? And it would seem like, okay, well, you're filing this own tax return, but you can't, okay? Because that S corporation is deriving income from a partnership that has employees. And now you're trying to set up a retirement plan for yourself and not your employees. And that, I say this all the time, financial advisors make fun of me. That's the definition of discrimination in a retirement plan. And the whole point of what I do is to make sure we're not discriminating against the employees.
Makes sense.
Did you get that, Blake?
I did. I didn't know that.
Quit referring partnerships to Missy.
I mean, but most people are not going to like this. It's called an affiliated service group. I mean, if somebody called me and they're like, hey, Missy, is this an affiliated service group? I'd be like, wow, you really did your research, because everybody's going to know that. And it's going to look like they have an individual entity. But that's a hard no for me to get that set up, because there is a likelihood that will be discovered by the IRS, and then everything becomes taxable. And so it's just not worth it. Now, I also have some doctors that they might be partners. They might be silent partners, and they're deriving some income, but then they do some moonlighting and they have 1099 income.
Mm-hmm.
Well, yeah, let's use that 1099 income. That's earned income from a completely separate entity, so who knew that I knew this much, Blake?
I know. Yeah, all we got to do is ask.
Feed her wine and she'll tell you all her secrets. It's fine.
Well, I think we did a good, background on it. I mean, I feel like I know more now. I think we did the job here for sure. Any other questions on your end?
No, I was trying to think like what, a normal person like me would have, but that was a really good explanation of it for sure. If somebody was interested in this, is it through you, like your umbrella of the company? Missy works at Falk and Winkler. I will put the links in the show notes.
Yes, so I oversee our Sentinel Pension division, which is a division of Falk and Winkler that handles all the retirement plan consulting and compliance. Yes. So
Okay.
all of this comes through us. This is why I know so much, because I've been doing this for a long time and I have a lot of discussions with people about it. Well, practice makes somewhat perfect to an extent.
Always perfect, Miss.
But to close, though, cash balance plan, when it's the right fit, nice tax savings, saving up a nest egg for retirement, got to commit to it for 5 years, and predictable cash flow is and set up as an S corp. Those are kind of the things that we're going to look for. If it's not a good fit, I will not set this up for somebody if it's not a good fit. I'm not going to set it up and take someone's money. I guess other people would, but if it's not a good it's not going to work. You can go try someone else, but you're probably going to get the same results, because the math is just math. So,
It just don't math. The math ain't mathin'.
Math ain't math.
Math ain't mathin', and
That's a lot of money in a retirement account.
One more
So
thing. I know we are I can talk a lot about this, but one thing that is really important, Congress, or the powers that be, actually did something really great with one of the pieces of legislation that was passed a couple of years ago. And that is, and I very rarely say that about anything that gets passed, but you can now retroactively set these up. Okay. So I'm telling I love it, because now if we get to the end of the year and somebody's like, oh, Melissa, like we have a huge issue, like I'm going to be making X amount of money over this, I don't have to rush and do it before the end of 2024. If you have a solo K, and even if you don't have a solo K, you can retroactively set up profit sharing plans with the cash balance plan now. So that's a nice little perk. Now you have to look at your cash flow if you're doing it too far behind, right? If you're not in July and you're trying to do it for the prior year, legally that can all be done. It's just a matter of what you can fund. So I wanted to throw that out there. Doesn't have to be done before the end of the year. Okay, I'm done.
So I don't have to do it in 4 days.
Yeah.
You don't have to do it. I think that's what I told your advisor. I said, let's not rush into this. So we can
He's trying to do all kind of things in 4 days right now, Missy.
I was like, no.
All kinds of.
I'm about to get Blake Muller into something before the end of the year that he doesn't 100% understand. And then
We're working on a few things.
Oh,
Because why not on December 26th? Are we setting me up for
that's Blake being entrepreneurial.
Yeah.
You know?
Yeah, leave me alone.
Yeah. It was nice. Thanks for coming on. We appreciate you.
This is awesome.
We know you've had a busy week, so thank you for adding on to it.
I can't wait to come on the Louisiana Ladies podcast.
You would be a Louisiana lad.
You'd be a Louisiana lad.
And I've already invited myself over to her house to enjoy the outdoor area. So
patio was a hit.
Right now.
Patio was a hit.
All right. Love you. Thank you.
Love y'all. Talk to y'all soon.
I'll put all the links in the show notes and our email too.
Okay. Sounds good.
Signing off.